Hi, welcome everybody. Larry Berman here. Normally you're used to hearing from my partner, Jared Rabinowitz, to kick off our events. And Jared got the good fortune of having some business travel. This is probably one of the first times that we're actually starting to travel about the country on business needs. So great news, things are starting to open up again. I'm just looking at the coronavirus update for the world, and today is the largest single day ever in terms of the number of new cases. And we are seeing, generally the death counts kind of stay moderate. I'll talk a little bit about that in my presentation tonight, but Jared sort of gives an introduction and thanks our partners, so I'm going to do that. And with a special reach out to everybody, saying that these events do come to you at no cost. There is a considerable effort put in on our part to share our educational views with Canadians. Love doing it. For those of you who have already made donations to either Sick Kids or Baycrest, thank you very, very much. The best and simplest way to do it is when you get the feedback survey that is sent out after the event within the first 24 hours, you can watch the replays, and there's a link on there where you can click on it, and that allows us to track the donations, and Jared and I and my group of companies match all those individual donations. And to date, we've raised over $500,000 in the last 7 years of doing these events across the country through BNN and for these two charities. So we're really thrilled and thank everybody for that support. We're also thrilled to be partnering with two great service providers in Canada. You'll all know of my long-standing relationship with Bank of Montreal and their exchange-traded fund business. Today we have Danielle Neziol to talk a little bit about BMO ETFs and do a bit of an education presentation for you. But first, through our partnership with National Bank Direct Brokerage, we have Iris Nee, and she's going to show you some of the great things that are available on the National Bank platform. So Iris, please take it away.
Great, thank you so much, Larry. Hi, everybody. I am super excited to be here tonight. So my name is Iris Nee, and I am the Business Development Manager at National Bank Direct Brokerage. Well, a lot of people don't actually realize or know that National Bank does have a direct brokerage, and we've been serving clients for more than 30 years. Our platform and pricing is one of the best in the industry. So before I actually start, I have a little disclaimer for you guys to read. So I'll give you some time to just quickly go over it. So basically, today's topic is to talk about finding dividend stocks. As you know, interest rate is very low right now. A lot of people are, looking for stocks that pay good dividends. So how do we do that using our platform? So what you see here on this slide is our trading platform. So on the top right corner, you will see the buy, sell, transfer, and get a quote. These 4 major action buttons are always at the top, so you won't miss it. If you need to find information on a specific stock or fund, go to get a quote, which is circled in yellow. So you type in the symbol or the company name. So in this slide, we're using Suncor as an example. And you can see the key quote information, the research, and then on the bottom right, you see the dividend information, right? So you see the dividend payment is 21 cents per share. If you buy the shares before September 3rd, then you will get the payments on September 25th. So the annual yield is 4.98%. So that's how you read it, and you will get the dividends on a quarterly basis. So how do you find the dividend stocks? So we have the research section. So under the research section, we have the stock select list. So you see there are 6 documents. So this section is updated every single month. to give you updated information, to give you updated quote unquote suggestion list from Morningstar or National Bank Financial. So number 6, I can see where the arrow points at is the Canada income pick list. So dividends, as you know, is a type of income. So in this report, you can see a summary how Morningstar is, summarizing how it's performing compared to the TSX 60. What are the top performers on that list, and what are the updates? Are there any companies that are added to this month's report, right? And at the bottom of this report, you don't see the whole report, but at the bottom of the report, you can kind of see, they give you a list of consider buying stocks, right? You can see the company name, the symbol, and then the Morningstar ratings. Okay, the current price as of the report date and the fair value, so what they think the company is worth. And then on the last column, you see the dividend yield, right? As of the report date, of course. So this is a very simple to follow list. Now, another way on the platform where you can find stocks that pay dividends is using Recognia, the strategy builder. So you can click on build screen, and then it'll bring you to a list of all the different criteria, and you can search from the folders. Okay, so you can choose different exchange. So let's say you want to search, stocks in the US market only, or the Canadian market. You can choose that. And then you can see here, this is only showing you some of the criteria, not the full list. But on this slide, we've already chosen some of the criteria here. So stock price, dividend yield, you can choose between any number you want. So in this slide, it shows between 4 to 10. You can even choose the industry, so banks, for example, share type, and dividend growth rate. If you're not sure what it means, you can actually click on the arrow, and it actually explains to you how this works and what it means. So based on these criteria, there are 10 stocks that match the criteria. Okay, so if you scroll down a little bit on this window, which shows on this slide, you can see the top 10, right? And you can click on view why to see why is BMO is number 6 on my list, right? So you can see where their stock price is at, the dividend yield, the sector, etc. If you like this screen, like this filter, you can actually save the screen. So there's at the top right corner, you can save the screen, name it however you want. And what's amazing about this tool is that you can ask the system to email you any changes to the top 10 matches every day, every week, or even every month. So it's really handy, right? So you can always save it. And once you save it, you will see it in your homepage in Recognia, which shows on the next slide. So it will show under my saved screen, right? But for those of you who don't know where to start, you want to get some kind of ideas from other people, you can look at the featured screens. So these are the screens that are built by Recognia itself. And then you can also take a look at the community screens, the screens that are built by other Recognia users. So if you like the Johnny Cash one, so that you can see the annualized return is 16.9%. Oh, looks pretty good. You can actually take a look at it and see if you like it. So you can take some of the ideas from it and then build your own from there. So this is just a very quick overview of our platform. If you need more detail, if you want more information, please feel free to reach out to me. You have my contact information, and this presentation will be sent to you later on, so you don't have to take picture or memorize anything here. It will be sent to you. So now the good news, if you've been following our webinars these few weeks, you know that we are the only brokerage that offer zero commission trading on all Canadian and US ETFs. Yes, you heard it right. It's all Canadian and US listed ETFs. You can trade them for free as long as you trade over 100 shares online and sign up for e-documents. For those of you who wonder, how about stocks? Okay, so for stocks, it depends on which package you have. So if you're an active trader, so I'm starting from the left column. So if you're an active trader, meaning you trade over 100 times per quarter, you only need to pay 95 cents per trade. Okay, and for young investors, people who are under the age of 31, okay, they get 10 free trades a year. So every year they get 10 free trades. After they're done with the 10 free trades, they only need to pay $4.95. Okay, if you have a bank account with National Bank, which is the third column I'm talking about right now, you only need to pay $6.95, meaning if you link your National Bank account, National Bank line of credit, savings account to your trading account, you only need to pay $6.95. Otherwise, the regular price would be $10. Well, if you're asking, well, can I not pay any commission for trading? The answer is, well, yes, good news. We have a promotion right now, which shows on the next slide. So if you are a brand new client to NBDB, so National Bank Direct Brokerage, you open an account before December 31st, you get 200 free transactions for your first year. So if you're opening the account online yourself, make sure you use the promo code LarryFall2020, which shows on the slide. But I would suggest that you either call our call center or go to a branch or call an advisor to open the account because they're more experienced in opening accounts, so that way is better. This is our contact information. Again, this presentation will be sent to you, so you will have our contact information, or you can feel free to contact me. Again, my name is Iris. Thank you so much, everyone, for listening, and I'll pass it back to you, Larry.
Well, thanks so much, Iris. That was a great presentation. Actually, while you were speaking, someone wrote in a question and it said, can you recommend a stock or ETF for a trade from now until after the election? And I thought, wow, wouldn't that be a great tool if they were clients of National Bank to be able to use some of those Recognia tools. So it's really exciting on some of these online platforms where, you know, you've got some of the tools that, you know, even some professionals have for screening out different investment ideas. So great work, National Bank there, and thank you very much, Iris. So, you know, on to the next part of the presentation. So I've been working with Danielle now for probably 3 or 4 years, 5 years in that range, Danielle.
Yeah, I think about 3 or 4 years.
Yeah, she's a product specialist with BMO Investments, BMO Global Asset Management, and a specialist in exchange traded funds. And today she's going to educate us. So take it away, Danielle.
Thanks, Larry. Yeah, maybe it feels like 5 or a lot more years because we've just been having so much fun working with ETFs together. So thanks so much for having me here tonight. Always so much fun to be a part of this event. I was reading the National Bank ETF report this morning, and BMO ETFs has $6.7 billion in net new ETF flows so far year to date. That's pretty incredible given this crazy year we've seen in the market. And then this is just one recent example of our success story at BMO ETFs. And this success really is a reflection of our incredible partners like Larry and ETF Capital Management, who have been using BMO ETFs since day one, but also a huge thanks to all our retail investors who are here tonight, who are watching, who believe in BMO ETFs and believe in our products because of all your support. You know, we are now 30% of the Canadian ETF marketplace, which represents around 68 billion in assets. So, you know, we really could not have achieved all this success and those accolades listed here on the slide without our outstanding investors. So thank you. And one of those accolades is that BMO is the #1 smart beta provider in terms of AUM in Canada. And smart beta is just a fancy name for factor investing. So tonight, I thought I'd like to have a conversation about this, and in particular, the quality factor, which has been having an exceptional year. So factor investing, simply this is identifying certain characteristics or fundamentals in a stock that may provide certain advantages over other stocks. So with the goal of outperforming the broad market over time. And active managers, they've been using factors for years to achieve portfolio alpha. And some popular factors you might already know, growth and value, momentum, and then more recently low vol or minimum volatility strategies have been gaining investor interest. But I'd like to introduce you to the quality factor. So this is kind of like the new cool kid on the block, so to speak, in terms of factors. And we're actually in an economic environment right now, which is really supporting the quality factor. And it's actually been outperforming all other factors year to date. So definitely a strategy equity investors should consider learning more about, or at least have on their radar. So BMO has 3 options for quality ETFs. And we were the first to bring quality ETFs to market and make this exposure accessible to Canadian investors. So what is quality? What's a quality company? What is quality all about? Well, the quality factor identifies companies which have higher profitability and stronger balance sheets than their peers. So these are kind of the 2 core ideas behind the quality factor. These companies often have competitive moats, which give their businesses sustainable and strong advantages over other businesses. So this is really what quality investing is all about. It's finding these companies with these fundamental advantages. So there are a lot of different ways managers can capture the quality factor, and BMO uses a unique approach. We use MSCI high quality indexes, which use a screen with 3 main metrics. So the first is these companies must have high return on equity, so higher profitability than their peers. They must have low debt to equity, so less leverage than their peers. And this has actually been a huge advantage for these companies this year, especially. And then lastly, they must have consistency of earnings. So over quarters and years, we look at variability of earnings, reliable earning streams. This is a key metric as well. And what's really been interesting about this factor this year is its ability to outperform in both bear and bull markets. So quality is doing this really effectively right now. And this year we've seen both a historical market crash and an equally historic market rally. And in both scenarios, the quality factor actually outperformed. So we like to say that the quality factor is maybe where both the bulls and the bears can agree. So what's driving the success of these underlying companies? I think it makes sense why quality companies are having such a great year, given this tough economic environment. So these are less levered companies, so they have less debt to service and more cash flow to work with. When the market crashes, this is a major advantage because these companies continue to pay dividends, pay their expenses, and keep afloat through challenging times. And that stable earnings growth metric is another big one. Companies who have had consistent earnings year over year, we've seen that these have remained consistent even through the most recent drawdown. So the market is rewarding these companies based on these fundamentals and has been for some time. If we actually go back to the last slide and just quickly look at these returns. So the graph on the left, on the last slide, shows the 1-year and 3-month performance of the 3 quality BMO ETFs and then the regional broad market. So all 3 outperforming the broad market on the 1 year and the 3 months. And then if we look over to the right, so when we look at the 5-year performance, ZUQ is actually improved on the S&P 500 by an annualized 3% a year. ZEQ, the European ETF, outperformed by an annualized 4.7%. And then the global ETF outperforming by 4% a year. So strong performance numbers to back up the quality factor. And again, it all comes down to those 3 metrics, which we use to identify the strongest companies with great balance sheets. These companies they're just best in class and have been clear winners on the short term and the long term when you look at these numbers. So for the bulls in the room, you can definitely make a case for quality equities as a long-term growth solution. And then for the bears, well, quality can actually be appealing to you too. So for investors who might want a more defensive approach to equity investing, the quality factor can be a more prudent way to play the market. So when you have companies which have less debt to service and more predictable earning streams, this makes them less volatile. And then the strong balance sheets mean more cash flows, which indicates that these companies can withstand an economic downturn. They're more prudently managed than their competitors. So we would expect these kinds of companies to outperform in negative markets relative to their peers who, might be more levered up or run out of cash or have big earnings misses. So looking at this data, this has been actually the most noticeable in Europe, which is the most defensive of the three regions here. And when you look at ZEQ, over the last 5 years, it's capturing only 59% of down markets and almost all the upside. And then globally, when we look at ZGQ, the ETF captures most of the down market, slightly less. But then in an up market, it captures much more, so actually by 16% more than the broad market. And the US, things playing it a little differently right now, where earnings and performance have kind of consolidated recently. So we're seeing this theme differ slightly here. The high quality strategy in the US captures slightly more downside than the broad market. But then if you look on the way up, it really shines. So makes up for any drawdowns once markets recover. Now, you can't have your cake and eat it too. So I'll just let you know that maybe the market backdrop where you might see quality underperform would be in a kind of an indiscriminate junk rally, kind of a risk on equity rally. You might find quality would rally less because investors in that kind of market might be overpaying for higher beta stocks. So I'd say in that scenario, quality could begin to lag. So great news. You can access the quality factor using a cost-efficient, liquid, and easy-to-use ETF. And BMO, we have three options. So the BMO MSCI USA High Quality ETF, ZUQ. So this ETF is overweight to growth-oriented sectors like healthcare and information technology. This is where the strategy is identifying a lot of high-quality companies in the US right now. So names like Apple, Microsoft, MasterCard. These are strong growth-oriented companies who have predictable earnings streams, strong cash flows, and low debt. But also keeping with that defensive growth theme, this portfolio will not own names like a Tesla or a Netflix. These kind of companies are screened out because of earnings variability and high levels of debt. And then we have the MSCI Europe High Quality ETF. So that's a unique exposure, maybe for investors who would like to add some European equities to their portfolio and perhaps diversify away from the US. So in Europe, we're finding quality companies today are coming mostly out of the consumer sectors and the healthcare sector. And actually, just an interesting note, Goldman Sachs released a report earlier this year identifying 11 European equities. They're calling these the granolas, so kind of a fun acronym. And the granolas are 11 companies in Europe which have strong, stable growth type companies, many or most from the consumer and healthcare sectors, which, as the Goldman Sachs report stated, were considered the best-in-class companies in Europe. Well, ZEQ is holding 8 of these 11 granola stocks. You can see them all kind of right there in the top holdings: Novo Nordisk, Nestle, Novartis, Louis Vuitton. So clearly some overlap in the quality characteristics that we look at relative to other analysts. So for exposure to these companies, ZEQ can be a really good option. And then lastly, the BMO ACWI High Quality ETF. So this is our global solution. This is such a great one-ticket global solution. So it's an ACWI exposure. So this means it has developed and emerging markets, so both included. The portfolio will tilt to wherever quality is in the world, defined by the 3 quality metrics. So right now, we're seeing more quality companies coming out of the US. So this ETF is overweight to the US, about 60% US equities, and overweight the IT and healthcare sector. So this is a true global solution, 40 basis points management fee. It's a really good one-stop shop for like a core portfolio building block. So before I hand it off, just to summarize kind of the key message for today, quality screening identifies market leaders. Market leaders with strong balance sheets are just overall stronger companies and tend to outperform in a tough economic environment and have been doing a very effective job of this so far this year. So that's it for me. Thank you so much for your time. It was a lot of fun to be here. If you're interested in tuning in, you should definitely check out our Market Insights webinar. They're free to join every Friday at 1 p.m. Eastern. And actually, I'll be on tomorrow to talk about emerging markets. So I think that'll be a really interesting discussion. So for sure, be sure to check that out. And so at this point, Larry, I'm going to pass it back to you.
Thanks so much, Danielle. You know, one of the, when BMO came out with the quality factor, you know, I did a Berman's Call educational episode on it. And what I focused on back then, a few years ago, was I said, you know, these high cost mutual funds that are out there, do you know what these portfolio managers are doing? They're taking a computer model and they're screening companies for great financial metrics, and they're charging you a huge fee for it. And now you can buy that same skill and expertise in these ETFs. So, you know, I love ETFs for what they do. The quality factor, it's been proven over many, many business cycles that when you get into difficult market environments like we are now, in recessions and in economic slowdowns, that companies with good, stable, clean cash flows and low leverage on their balance sheets tend to shine. And that's clearly been the example tonight that Danielle showed us. So thank you very much for that, Danielle. And on to my part of the evening. So, you know, we've been focusing on obviously the election, and that's still very much in front of us. Just saw a headline cross the tape, which has moved the futures markets around a little bit here, where there's now some skepticism in the House, in the U.S. Congress, that they don't want a stimulus bill and they're not going to vote for it. And anyways, it's been very, very interesting to see how the market's responding to stimulus and not stimulus, and risk on and risk off. And it's been tremendously noisy. What we saw just this week hit the tapes was a committee structured against Google. And so I want to talk a little bit about antitrust tonight. I want to talk a little bit about hedgers and speculators in the futures markets and what we can glean from that, a little update on the elections and markets, and then obviously give you some current opportunities and ideas, and then Q&A. So hopefully that works for everybody. And I'll get right into antitrust. So, you know, I saw George Friedman writes an excellent blog, and it's, you know, for a couple of $100 a year, they talk about all these geopolitical risks in the world, from brewing wars and political conflicts to things like this. And, you know, I clipped some of the language from George's blog post today, and I want to share that with you because he talks about free speech and you know, the Bill of Rights and the First Amendment. And he basically says that, you know, when the founding fathers wrote the Constitution, free speech was about your ability to stand on a street corner on a box and tell people what you thought of things, and they could question you, but it was public and it was open as long as there was no hateful intent. That is the Bill of Rights, and we have that in Canada, and we all know that, you know, public speaking and that should not be censored, right? But with social media the way it is, one person can be 20 people online, no one knows who they are, and they can put all kinds of nonsense and BS and spin on all kinds of topics, and then you don't know who they are, and there's no identity. So the founding fathers never expected to be, say, divorced from responsibility. So if you're I'll use an example that I'm very familiar with, being of Jewish heritage. If you're a Holocaust denier and you're standing on a street corner, people can call you out. Like, just about everybody knows that that's very real. But they actually did a survey recently, and 40% of people think it was kind of made up. Like, I don't know. I'm just beside myself, frankly, on some of these things. But this whole idea of censorship in media, and really some of these antitrust things. So basically, it's the anonymity and what he thinks they're going to see, and I kind of agree, is that, you know, if your business model is about you know, infringing on this free speech, that they're going to have to, you know, you can still say whatever you like, but you have to disclose who you are. And I think that's going to mean a change in the way some of these models work, because right now, almost nobody pays anything to use Twitter and Facebook and everything. And they have these premium models where you can pay, and so you don't see commercials and things like that on other media, and you can pay like a premium service subscription. But largely, when you're not paying, you're the product. And one of the interesting things about this is, you know, how much of a benefit has being able to do a Google search and a map. I remember, I think, my first car, and they said, well, would you like a GPS option with it? Well, how much is that? Well, it's $3,000. I think the whole car was $12,000. I'm like, you got to be kidding me, right? Yeah, but it's a map and it gives you directions and it's really wonderful. And today, of course, that's free on your phone. So, you know, they haven't measured the productivity enhancement of technology very, very well, and the benefit. So, and there's been a couple studies that have gone out like this. And so I'm going to actually do a poll survey tonight. And the question, folks, here is pretty simple. Okay, so here's the question: would you pay monthly for access to social media? No, I wouldn't pay. Or would you pay some amount? So I just hit the launch. Well, did I? Oh, geez, I closed it. What a bonehead I am. How can I relaunch that? I don't think I can. Oh, dummy, Larry. So how do I restart this? I don't know. And this is why. Okay, well, sorry about that, folks, but I clicked the button quick twice and it didn't work. But think about it. How much would you pay, you know, to access social media here? And ask yourself that question, because right now it's free. But if you had to pay $10 a month, would you use Twitter? If you had to pay $20 a month, would you use Facebook? And for some, the answer would be yes, and some would be no. But I think this is the way it's going to ultimately end up, because what that allows them to do is to identify who owns that account. And we'll see how this all plays out, but it's going to be very, very interesting. Again, sorry for botching that poll on everybody there. I thought that would be really fun to see what the audience has to say. So now, this chart crossed my desk this week, and it's from a research service provider that I use. They're very, very good. Jason Gopeford, the founder of Sentiment Trader. And I probably pay about $1,000 Canadian a year for the premium service. They have lower models, but you know, they put out every day some great charts. And so he put this one out, and it was very interesting because this takes all the hedging positions, because on the other side of a futures trade, when someone's a hedger, they're usually a bank or an insurance company or someone who owns underlying securities, and they're trying to neutralize the market risk. But the person on the other side of that trade is typically the speculator. So you have hedgers, people who want to protect risk, and then you have speculators, people who are seeking risk and making directional bets. And then that's further broken down between large speculators, which might be big hedge funds, or small speculators, which might be individual investors where they're doing 1 or 2 contracts. They don't have a lot of money compared to a big institution that might be hedging billions of dollars. Okay. And so right now, when you take all the major index positions combined and you look at the hedgers' positions, the hedgers are currently hedged and net short, which means the speculators, so they're neutralizing their market risk, which means the speculators on this last dip here in September got very long. So this is very interesting because it's the speculators that are open, exposed, and more at risk. And when you combine that with the institutional investor surveys or the AAII, what you're seeing now is a lot of speculation, not only in position squaring in the futures market, in what we've seen in option pricing and people buying out of the money calls, but they're positioned for it and they're telling us they're bullish. And that leads the market open to being priced for perfection and at risk for maybe some downside volatility. So that's a little bit of what I'm seeing here on the sentiment side, and I thought it would be interesting to share that with you tonight. So hopefully that adds some value for you all. Now, turning to the elections, the election map on 270 to win was unchanged from last week, meaning they expect the exact same outcome and based on their consensus of polling. So remember, 270 to win takes about a dozen different polling sites, aggregates them all up, including 538 and Rasmus and Crystal Ball and all the kind of big ones that people are looking at. And they're basically saying no change at the moment. So with all the back and forth and all the COVID with the president and all the kind of back and forth, no change in the polling. And so it's going to come down to the key swing states. Now, there is a polling service that I'm going to talk about in a second here that's kind of interesting. But here's another chart that crossed my table in some research this week, and it went back and looked at the polls from 2008, 12, 16, and then kind of what actually happened. So, you know, for key swing states like Florida, Obama carried, was ahead, Trump was ahead, but in the surveys, in the polls, Clinton was ahead by 4%. In Florida, and Trump won by 1.2. So when you look at all the differences between what actually happened in 8, 12, and 16 compared to what the survey said, you see a couple of real outliers. Clinton was ahead in Pennsylvania by 6% on election night, and Trump won by less than 1%. Clinton was ahead in Wisconsin by 7%, and Trump won. So there's this talk about, and Michigan was another big one, there's this talk about the silent or the invisible Trump support, where you get called by someone you have no idea who's on the other end of the phone, and they're saying, are you a Trump supporter? And are you, and a lot of people were undecided or didn't want to tell anybody that they really liked this guy. Now, I think the pollsters have narrowed that down, and they're doing a better job at it than they did 4 years ago. The midterm elections kind of showed that at the state and Senate level. However, Donald Trump wasn't being elected that election, but really there's still a Trump effect in these things. So they think the polls have narrowed. So the silent Trump vote is narrowed. One of the big things last time around was the undecided voter. So going into the election a week or so before, the undecideds were still 10, 15%. And now with a huge swath, something like 40% of people have already voted in the early elections or by mail. And the undecideds are less than half of what they were before. So there's a lot of interesting things at play here. And it's going to come down to these key swing states. And because Pennsylvania and Michigan and Florida are really, really big in terms of their electoral college numbers. That you know, it's interesting. Now Georgia is very interesting. Georgia over the years has migrated to more of a Democratic base vote. And there's some reasons for that, but Trump was ahead in Georgia 4 years ago. He won by a similar amount to that he was ahead. And right now the polls are saying Biden's ahead. So that's an interesting state to watch on election night for sure. But Florida is also a very interesting one because Biden's ahead. Clinton was ahead. Trump won by 1.2%. So Biden's ahead by less than Clinton, but that vote's narrowed. So it's going to be very, very close. But in Pennsylvania and in Florida, because of the way the mail-in voting has gone, Florida can count their mail-in votes starting now. Okay, 22 days before the election, anybody mailing in or voting early were counted. But in Pennsylvania, Michigan, and Wisconsin, they can't count those mail-ins until election night. And it might very well be that on election night, Donald Trump is ahead. Now, if he loses Texas, he's cooked. Okay, if he loses Florida and Arizona, he's cooked on election night. He can't win mathematically. So it's going to be very, very interesting. But what most likely happens is on election night, Trump might look like he's winning. But if Pennsylvania is within a few points, and it's likely to be very close because it was very close last time, and then they start counting all the mail-ins, which is going to be 70-75% Democratic because of the polling that they've done, and they know Democrats are more likely to mail in than Republicans are. It's going to be very interesting as those results come in and maybe Biden pulls ahead. In which case, hello, Supreme Court and lawsuits, and let's get those ballots thrown out for any number of reasons. And that's where the constitutional thing happens. And it might happen in many states. It's really going to depend on how close it is on election night. So those things are really super important here. Now, I talked about this polling firm called Trafalgar, and they've been ranked because largely they got it right. They were declaring Trump, and I think we're the only major polling firm that declared Trump the winner pre-election in 2016, where all the other ones were and they still say there's a hidden voice. So for those of you who want real-time and good stories and analysis, go to the Hill and you can follow on there. I think there's a number of free stories before you kind of have to pay. But you know, I get access to this. And so in Pennsylvania, look at these two headlines. So Trafalgar says that they're missing the vote, and if you read down in the story, it says based on Trafalgar that Pennsylvania is way closer than Biden being ahead by 7. So it's going to be very interesting. It's going to be tight. And there's going to be a period of weeks, I believe, after the election where we may not know who the president is. And so, you know, they talk about stimulus and maybe passing it in a lame duck. If we don't know who the president is, nothing's getting passed by Congress. Okay, until we know who the president is. So I think best case scenario, the stimulus bills get written into law and paychecks or money doesn't hit people's accounts till after Christmas, sometime in probably February. And that's going to be interesting for markets to see how all that is handled. But at the end of the day, folks, here's the biggest problem for everybody out there. I've had this chart on every week. I think it's the most important chart that people need to understand. And when you combine forget capital gains for a minute, because they're pretty much gone from the bond market with yields where they are, although there's some room left. But the yield from equities, from broad indexes, and so for that typical balanced portfolio has never been lower in the history of the last 100 years plus. So this is a big problem for people's retirement accounts. And hence why I guess TV shows like mine are, and people want to get educated and they want to learn how to manage their own portfolios. So I'm really glad we can be here with this type of education and so forth. So a couple of ideas for you guys tonight before we go into the Q&A phase. So here's an ETF that I featured last week on my YouTube channel as I'm not buying it today, but here's something to play the reopening in one place. And one of the great things about ETFs can also be a drawback is that you get to buy everything in an index. Well, here's an index that's based on entertainment and leisure, and a lot of the things that people are wanting to do again, but aren't at the moment. Casinos, all kinds of media and entertainment, concerts and so forth, consumer services that they're not doing today, a bit of retailing, a bit of food services and so forth. So here's an interesting ETF that when things start opening up would be something that probably has 50% upside. So the question is, Larry, do we buy this today? And so obviously, technically, you look at that chart and you say, oh, it's up against the 50 and the 200. They're crossing. Looks like it could be a breakout. We're getting vaccines. And so for some of you, that might be a trade. But what if this second wave of COVID is bad? So again, today, I'm just going to refresh my screen here on what the COVID number is. But I think we're going to see within a month probably something close to 1 million cases a day globally, with the death rates, going daily maybe above 10,000. And while that might seem small to some people, overall, I think it's quite material. In terms of what economies are going to be doing and social distancing and just not being able to open up again. And despite the success of some of these viral treatments, remdesivir got FDA approval for fast track in terms of COVID treatments. This is one of the drugs that the president took. I think it really matters. It's going to be helpful, but in order to get remdesivir, you got to be the president of the United States or very sick, right? You're kind of ventilator stage. So this is not a something that you can take a pill for and you don't have to worry about COVID. So a lot of people don't misunderstand, I guess, and what some of these things are. And I still say you got to go with the science. And what the people are telling us is there's not going to be widespread, broad vaccines for everybody so that we can feel comfortable normalizing again at earliest the second half of next year. So the next few quarters and the winter months, when the flu season is most acute in the Northern Hemisphere, which is the vast majority of the world, we're going to see another big wave of COVID, which means more shutdowns. Poor me, I'm not playing ice hockey anymore. We were back to playing, and now they've shut that down. You can only have 10 guys on the ice, which means you can't have any goalies or 4-on-4 kind of hockey and no subs. So that really doesn't work, and the gyms are closing and things like that. As a hit to GDP, it's minor. But it's that behavioral thing. And frankly, people are getting very fed up with COVID. They want to. People are they're easing off on the masks and they want to go to restaurants. And so as people go inside in the winter, we are going to see this thing start to spread. And hopefully some of these treatments are as promised, but we're not going to have herd immunity anytime soon. And frankly, from a world basis, we're looking at 1 or 2% of the global population that's had COVID, and it could get up to 10 to 20% if this flu season is bad globally, which does mean 1 million or millions of people daily, assuming the testing capacity is there. Okay. Another idea for folks here. Go back a page here. So Social media. I talked today about Antitrust. So there's an ETF, ticker symbol SOCL, and you can see the names in there, Twitter, Snap. So Snap had a big up move this week, Facebook, Tencent, all these social media names in one place. And wow, look at the run up. It's doubled since the lows there. So I'm actually saying for now, this is a short. And for those of you looking to hedge downside risk and antitrust risk in particular, this would be something that if you're so inclined to short it, that would be a way to do that. I'm not saying I'm going to do that right now, but this is something in the long short world that for me right now would be a short. Now, if it came back into the mid 30s and we kind of tested the support from the 2018 highs and early 2019 highs pre-COVID, and we developed some support there, and you like social media, then it's risk on and go for it. But I think this sector is going to take a breather. What we also know about when things recover is the stuff that's benefited, i.e. the big tech names, the money comes out of those overpriced and overvalued names and goes back into the banks and the entertainment stocks and all the ones that have lagged this year. But is that trade today or is that 6 months from now? And that's the only question I have in terms of timing on these two ideas. Do we do them now or do we leg into them and use them as opportunity? So my refresh here on the Worldometer just came in, and we're now up to 471,000 cases globally again, which is the biggest day with the death count a little over 6,000. So that's it there. And again, refreshing my shopping list here. I love all these things, but right now the whole world of tech is very overbought, and the clean energy space in particular, ICLN. We saw a big reversal in some of the solar names this week, and specifically a couple of the Asian solar companies got whacked. And this is a recognition that maybe the Green New Deal is not going to happen, and maybe the race is going to be closer than people think, and maybe there's some uncertainty here. So why pay a premium price today? Why not take some money off the table in some of these more overbought sectors? So I think that's in front of us here. Be careful on the technology side in the short term here, but all these things are super buys on pullbacks, at least to their moving averages, 100-day, 50-day, 200-day kind of thing. So, all right. So let's go into some of the questions that people have mailed in. And by the way, if you are not familiar with our new YouTube channel, we launched a couple months ago, Larry Berman Official. This is going to be our portal, so you can see replays of webinars like this. You can see my ETF 101 series that has been sponsored by National Bank, and all the other social media and educational content we're going to be coming out with in the future. And there's a lot of learning. We're going to be doing a series on options. There's very excited about what we have planned down the road. So the YouTube channel is where you'll get all that content. Okay, Q&A. So Roger is wondering what I thought of ZWK, the bank covered call ETF. So I've actually started buying that. And I got to tell you a little bit about how I execute trades here. So ZWK is the ETF, and I look for relative value, and I look for relative value compared to the world index. So I actually have a screen set up here that I use to look at some of these relative values. So ZWK had a bit of a sell-off here. And what this yellow line is, this is a linear regression. So it's the trend of the last 3 months. with standard deviation bands. And so for short-term entries, I look at these shorter-term time frames, and we got 2 standard deviations below short-term trend. Now, the long-term trend for banks has been down. Fundamentally, on an absolute basis, we've seen some stability coming off the lows. On a relative trend, so relative, in this case, this yellow line is relative to the ETF VT. And I think you might be able to see that there as its highlights. So it's ZWK divided by VT and normalized, meaning where I start the chart, it starts at 100, and where it's at an end, that's the current ratio. So ZWK on a price basis has underperformed the world index by 33%. So the current ratio's at 66.78. And so it's been underperforming. But what we saw at the recent lows, we started to see this relative underperformance trend start to improve a little bit, right? So we didn't make lower lows. So that's kind of interesting. Price made a lower low, but relative didn't. And to me, that's one of the trigger signs. So I've only added a like 1.5% to this ETF in my dividend yield focus fund. And the next time it gets a value, relative value, I'm going to buy it. If it takes off to the upside, great. I bought it really well. I was buying it under 20. So I bought some at 20. I bought some at 1980 and 1955, I think, were the 3 zones that we had algos working over the few days that we're dipping in here. And so that's kind of how I do things. But I've got some professional tools to run algos and to accumulate positions. So I have a little bit of an advantage over the typical do-it-yourself investor. But National Bank, Bank of Montreal, they all have pretty good tools for you to do some of your own trading. But ZWK, I've nibbled at it. Here's some of the risks. If the yield curve doesn't steepen and we don't normalize economically, then this is going to remain a laggard. So, on a relative basis, I bought the relative index when it was around 62 or 63. And I do expect some resistance in this 24 area fundamentally, then that might be an opportunity to take that money off the table again and perhaps reset. So as I expected, I have had my Bloomberg log out on me here. So I've got to log back into my Bloomberg. My internet connection is still up as it would appear. So let me log back into my Bloomberg here, and hopefully we can do that without a problem. Looks like I've logged my Bloomberg terminal. All right, let me page forward here to the next question, and I'll see if I can't bring that Bloomberg terminal up again here. Can I comment on my expectations for ZTL, which is the 10-year US Treasury ETF? So short term, we're going to get a lot of we're going to get a lot of pressure from supply. And when we look at US 30-year yield, which I'm trying to bring up a chart for here, hopefully you guys are seeing this here. I'm not sure you're getting feed here. Okay, so it is working here. Okay, so it's just a little bit delayed here, and I'm having, unfortunately, some internet challenges, um, which does happen. So here's the chart of 30-year yields, and we had volatility back in March around the first shock of COVID, and then we had risk parity funds sell just about everything they hold, and bonds and gold sold off aggressively. So we're now getting up to very interesting yields on the 30-year here, where we saw a spike a few months ago, and so it's supply pressure that's putting a bit of stress on the bond market right here. But what's interesting about this, and in the short run, I have no exposure here, but it is something I will buy at some point. I'm just not doing it quite yet. And my target here on ZTL, but I'm going to use TLT here because TLT is the US version. And when I bring up a chart here on TLT, because ZTL has embedded the Canadian dollar with it, if we break, and we've broken the 200-day average, if we break this low here on TLT, which is 153, we're at risk for a sweep lower, and we just get just a sell. And it's that selling where stops start getting run and maybe we push a bit below 150 that we start to get interesting. So that's somewhere around 5% lower on ZTL, plus or minus what the Canadian dollar is going to do in that environment. And that's the challenge. When you're using ZTL, you've got actually two things that you're trading there, the currency and that. Okay, so that was Ron. Next question here. So Linda is asking about these ARC ETFs, where a company called Emerge has come out with Canadian versions of the ARC ones. And she's saying the MER is way higher in ARC, 1.8 versus 0.75. Is it worth it? Well, I went to the Emerge website and checked the MERs, and I actually don't see that. I see it as being 0.8%. So, Linda, I would ask you, where did you get that number from? And maybe that's not correct. Or maybe it's a version of the ETF that includes some sort of advisor compensation. And I'm not sure that that's the case, but it might be. That would explain the difference. But I love the whole ARC series, and Emerge has brought those Canadian dollar versions to Canada in them. My timeline's 10 to 20 years, by which time I'll need Canadian for retirement. Do I think the Canadian dollar will be stronger in 10 years? Linda, I have no idea. You know, it's government policy, amount of debt. Nobody can make a forecast out that long. So I wish I could help you, but I have no idea. I can tell you what I think about the next year on the Canadian dollar, and is that at the moment, I'd prefer to have more US dollars than Canadian dollars in my portfolio right now. But on an international basis, I probably prefer to have more euros and more emerging market currency exposure than US dollars, because I believe the US wants a weaker currency, and given Fed support relative to the rest of the world, we may just see the US dollar weaken compared to other currencies, but shouldn't compared to Canada, because the Bank of Canada largesse is actually bigger at this point proportionally than what the Fed is doing. Ryan's asking, can I describe my current option hedging strategy as for protecting my portfolios from any US election-related market correction, and how long would I keep it on for? So right now I've got December options. I've got puts that I'm long and calls that I'm short. So my beta is pretty much hedged in all my portfolios. What I don't have hedged is my gold exposure by bullion and gold equities and any fixed income. But all my other equity market exposure has been hedged in the portfolios. So if we get an adverse response in the weeks following the US election up to December 18th, I'm going to be fully hedged for that. And what I'm expecting to do is sell my put and buy back my call, and then expose the markets to a post-election rally, which pretty much we'll get once certainty starts to develop or becomes clearer on how that's going to play out. So thanks for that question, Ryan. Grant is asking, hi, Larry, first timer, although I've not missed a Berman's call or webinar yet. Well, thanks, Grant. While I do have some somewhat diversified portfolio, I have absolutely no exposure to gold or silver in any way. That said, what ETF do you recommend to add gold or silver today if you were 6 to 8 years from retirement and looking to build a 5% holding for the next 2 to 3 years? So for right now, I like the US dollar, so I would buy a GLD or I would buy a GDX for gold miners. If you were looking at silver, SLV for the silver bullion, and SV, is it SVR? Oh, it's silver equities, SIL for silver equities, if you want those exposure. The silver is going to be more volatile than the gold. Goldman Sachs today just said by the end of next year, they think gold bullion's at 2,300. I'm in line with that view. I believe debt monetization is going to be with us for years and years and years into the future. There's going to be an awful lot of stimulus money that's going to have to be monetized by the central banks, and we will see ever increasing negative real yields with central banks now more acceptive of inflation pressures, and that's just wildly bullish for precious metals in general. So the degree that you have for each of them and what you use, Grant, is largely going to be a timing thing, and I would say start nibbling now at gold equities, silver equities, gold bullion, silver bullion, etc. And there could be some volatility through the next few months. If stimulus gets kicked down the road, then we can expect gold bullion and gold equities to sell off more, because the Fed isn't going to increase the QE without that extra demand on bonds and from stimulus. So the Treasury needs to ramp up their issuance, and then the Fed will step up, I'm pretty sure. But if the Fed doesn't step up, that would be something material here, although they said they would. Marlo says, Larry, I'm encouraging financial support for Baycrest and sick kids. My viewers would benefit from the understanding of how in-kind donations of stock securities from non-registered accounts is an ideal charitable giving strategy, and how public charitable foundations, now Marlo put in the name of a foundation that I believe Marlo uses or maybe part of, and I didn't want to give any free advertising there, so I took that name out, Marlo, sorry. Can be used to facilitate these transfers if the charity does not maintain a brokerage account to receive the transfer directly. So there are a number of institutions that do this. Most charities do have a vehicle for people to donate in kind. And in fact, one of our BNN viewers did donate $1,000 in a stock that they had to the Baycrest Foundation, because they had family members who suffer from Alzheimer's, and it is a fantastic way. So let's say you own a stock, and that stock you bought for 500 is now trading at 1,000. You can make a donation, get a charity receipt for $1,000 for the full value of the donation. You don't have to pay the capital gains tax on that, and you get the charity receipt. So wow, isn't that fantastic? It's a great way to give. So Marlo, thanks for that question. And for anybody out there in that situation, if you are interested in that, please reach out to my office, and we'll get you more information on how that could be done. We'd be thrilled actually to match a donation like that. So last week we're talking about digital currencies. What do you think of Emerge ARC FinTech? So here again, these are ARC ETFs but are from the Emerge version, the Canadian version of this company. And I mentioned Emerge on ETF and BNN a few weeks ago, yes. So Mike, what do I think of Emerge and FinTech? So I love it. I love it. But right now, again, on my buy list is FinTech, extremely overbought. So let me see if I can bring up my charts again here and see if these are going to work for everybody. So I'm going to, there's no history or not much history on the Canadian version. So I'm going to go to the ARC FinTech. So it's the ARC F here. And we're going to look at, see how much history we have here. But you can see that, you know, this thing was trading at 17 and now it's at 40 something. So, you know, there's the pullback, higher highs, higher lows. So everybody loves this. I would say it's probably a buy closer to the 200 day. So when are we going to see that? So I have no idea, right? And that's the hard part about trading and investing, because the question I always ask is this: okay, I like it. And let's say my maximum position in any single ETF or stock or whatever it is, barring, you know, like the S&P 500 or the TSX where you're buying the whole index, you know, 5 or 10%. Okay, so if you're running a concentrated stock portfolio and you have 20 stocks, 5% each, that, statistically speaking, is an aggressive portfolio. Anything less than 20 names, uber aggressive. And I'm never going to do that or recommend that. But so let's say you like the FinTech. How much, if 5% was my maximum, would I put into this today? The answer wouldn't be more than 1%. Because I like it fundamentally long term, but the risks to me are too high. Now, if we get a pullback to the 50-day average, given that it held there before, maybe that's 2%. And by the time it gets to the 30, 4%, if it breaks to 30 and retests, say, you know, the gap, let's call that the breakdown gap around 25, then I'm all in. Because at 25, I think fundamentally, you have to like it if you like it long term. So the question is always, how much should I buy now relative to the risk compared to the maximum position I'm willing to hold? So that's one way to do it, and that's how I think about it. But if you're a short-term trader and you buy 5% here, and then it goes to 40, and then it goes and it breaks the support, you know, it breaks this low and you put in your stop. So you've bought it here, 5%, you stopped out here, and then it hits 35 and shoots higher. What do you do? So do you want to be whipped around by the noise, or do you want to be a smarter investor? And that's where trading with stops and everything becomes a bit of a challenge. And you've got to know what your skill set is and your ability here, because frankly, me nor anybody else knows where this is going to go. Okay, so Mike, great question. I don't own it today. I'm waiting for a more meaningful pullback. If I don't get it, I'm not going to own it. And I'm okay with that, right? But no more than 20% of your maximum position today on whatever that would be for you, Mike. How are we doing here on time? We got about 15 minutes left. I got a few questions left here, and I want to save time for some of the online ones. Okay, so Todd asked about dividend-paying stocks. So I'm looking at ZDY as a US. So he's got plenty of Canadian, but he wants some US one, and ZDY, and he's comparing that to the Vanguard Income Growth ETF, EGG, Dividend Achiever ETF. So would I recommend, so I did a bit of analysis on this, and if you look at VGG, so let me bring up the screen again here, the Bloomberg slide, and let's look at VGG. So VGG actually holds VIG with a wrapper on it for a Canadian. So the underlying ETF you own is VIG. Okay, so VIG looks pretty good. And when we do a comparable, So I'm going to now do a comparable of total return of VIG versus ZDY. And I'm going to do that over the last 5 years or so. And so what you can see is the Vanguard one did better. It didn't do better in here, but it did over here. And you kind of say, well, why did that happen? Is it a better ETF? And here's the answer. Okay, so when I do a portfolio analysis of VGG and look through it and see what's in the ETF, you learn something very, very interesting from a sector perspective. So what this is going to show me is it's doing it for the bond ETF. Why is it doing that right now? I don't want that. I want this for VGG, and I'm disappointed that it didn't give me that. Oh, so VIG. Let me do that again and do that same. No, not VVIG, it's VIG. VIG, and let me do the portfolio function here again. And so the wonders of modern technology, eh, folks? And so this will take maybe 30 seconds or so. So this gives me the weighting by sector. And sure enough, information technology, which in general doesn't pay big dividends, is actually the biggest weight in the sector, followed by healthcare and consumer staples in there. What you don't have a lot of is financials. Okay, so that's very interesting. Let's see what's in the information technology sleeve. Microsoft, Visa, Oracle, Qualcomm, Accenture, and the list goes on and on and on. So in this ETF, okay, technology, which has been a leader, has been outperforming. And healthcare, which has also been a leader, has been outperforming. Let's have a look at what's in ZDY. So this is the US dividend ETF. It's a fine ETF. It's got a great makeup of stocks in it. But what's interesting about this one is it takes a different approach in terms of sectors. So the other ETF was a dividend growers. This ETF is more about stable dividends and size of dividends. So the actual amount of dividends, the percentage in the other ETF was lower. This one is higher, but it's higher because it's more mature dividend payers. So the big leader in here by sector is financials. And you'll all know that financials have sucked the wind this year and for the last few years. So is the VIG or VGG ETF better, or it's just better for now? And so you have to look through these ETFs. You have to understand them. You have to have the tools to do them. And I know both the BMO ETFs website has some great tools for this, and as well, the National Bank Brokerage website has some good tools for this to kind of do some screening on these ETFs to actually figure out, you know, what you're ultimately owning. Look at information technology is still pretty big here at 12.5, but look at the names. There's no Microsoft. Huh. Well, that probably right there is one of the biggest differences. And look at the dog called Intel that's down 10% that it owns. Anyways, my point being that if you go back and look at that comp chart again, and we look at ZDY into VIG and go look at the last 5 years again, what you saw is that during this period where the BMO ETF was outperforming, financials were kicking butt relative to technology. Very, very interesting. So it's not about, it's about now. And so hopefully that answers your question. I think it was a very, very good one, Todd. And what I would say is that if we're going towards a reopening and more value stocks outperforming technology, that actually the BMO dividend ETF might be a better performer going forward than the more growth tilted one of the dividend achiever was when you look at past returns, because it's not about past returns, it's about what's likely coming forward. So great question, Todd. Thank you for that. Steve asked, taking Bob's question a little further, and perhaps what he was getting at, rumor on the street is that governments are talking about going back to principal protected bonds that pay interest only, that are never redeemable. So interesting, issuing zero coupon bonds. I guess there's some of that, but yeah, interest rates are too low to factor those. So Steve, I don't think those are going to exist anymore. So let me go to some of the online questions here, and we'll go into some of the earlier ones that have come in. So someone's asking me about Brexit and should we buy or wait on ZWE. So ZWE is the high dividend covered call strategy in Europe that has exposure to the UK. Right now, the UK is the cheapest stock market on the planet because of Brexit. And whether there's going to be bumpy rides or not, the currency's cheap, the market's cheap, it's got a high exposure in financials and energy that's more value oriented. And I would argue over the next 5 years that the UK might be one of the best investments on the planet at this point. Now, I've taken an initial position, and I'm going to be building my exposure into the UK as we get closer to the end of the resolution of Brexit. So I do like it, and I wouldn't let that shy me away at the moment. Mark, if you want to get more timing specific, then you can certainly wait for some post-election volatility as an opportunity to buy into not only this name, but some of the other ones you might be looking at as well. Larry, would I recommend ZGQ and ZEQ? So those are the two ETFs that Danielle talked about, European quality and global quality, and the answer is yes. But as Danielle showed, there's actually a high exposure to technology and some of those great technology companies. So this is very interesting. So the quality factor, which I love quality, also has a growth tilt to it. And I think in the short run, even though I like it longer term, that if value starts to dominate over growth, which I had talked about in past weekly episodes, that you might be into an underperformance period in some of those names, and that would include the quality factor. I would definitely buy them into market pullbacks, but I wouldn't be buying them today. So thank you, Roger, for that question. Sean is asking also about ZGQ, and is it diversified enough for, say, a 20-year investment? ZGQ Global Quality has about 300 stocks globally in it, so more than ample diversification that includes exposures pretty much all over the world, excluding, I think, some emerging markets. I don't think there's much, if any, emerging markets in there. Is the difference between an index and a fund due to the exchange? Kamal is asking. So that's an interesting question. So when you compare a fund to its targeted index, a few things. If there's hedging involved, that could be a factor because there's a cost of hedging strategies in terms of forward points. That could be a factor. When trades are being made and the index is trading, there's no cost applied to trading. So the more an index rebalances, the more drag you would get from the buying and selling cost, the bid-ask spread and things like that. So the more frequently something rebalances in terms of an index, the more it's going to have a slight drag versus the underlying. And the index providers and the ETF executors try to minimize those costs, but that does show up in what's called the tracking error between the index and the ETF. So thanks for that question, Kamal. Can I provide some ETF names to take advantage of the upcoming inflation. Gonzo Bean, I guess you want to be anonymous in terms of your name, and I really apologize if that is your real name. But I did talk about some ETF names that I like. But on the real side of things, the one that I mentioned, and that is how to play infrastructure, is ZMT. So I'm going to bring up that screen again, the Bloomberg screen, and I'm going to bring up ZMT, and we'll do a similar type analysis here. So ZMT, as you can see, is the equal weight global base metal ETF. And there's a US version of that, which is the MSCI Global Metals and Mining ETF, and the ticker in the US is called PIC. Now, it's not the same index. The BMO one is equal weight, but they're targeting the same areas. And if you look at the last 5 years, and I think I can probably get something closer to a 10-year history here that I'm going to try to get daily if we can. And let me just get up to current here. So you can see that base metals over the last decade or so both have performed very, very poorly relative to the rest of the world. And I think these sectors benefit by being real assets and real commodities. So as central banks want more inflation, and as they need to build infrastructure to put people back to work, you're going to see, I'll use copper as an example here. So as we look at what the exposures are in these ETFs, if you think about copper, when you make a car out of the carbon-based fuel, you leave somewhere between 30 and 40 pounds of copper in that car, okay? Now, again, I don't know, and here it's got the dividend one again. So let me get ZMT loaded in properly here. So it's in my logic. And now let me do the portfolio analysis on that. So 30 to 40 pounds of copper in a typical average carbon fuel-based car. So when you look at what sectors they are, obviously materials are a big part. There's a little bit of tech in there. But I'm actually going to look at it on an industry group basis, not on an economic sector basis. So materials is the sector, but when you break it down, you actually get exposure to, no, that didn't do it. Let me get the sub-industries there. You see if that does what I want it to here. It should. Okay, so broken down further. So exposure to steel, exposure to diversified metals and mining, so companies that do a lot of things, BHP, and stuff that, other sectors, different kinds of metals that aren't base. Copper, 21%, aluminum, 21%. So if you look at some of the copper names, those are the names you own. Look at some of the aluminum names. Obviously, Alcoa and Century are going to be there, but you've got some other ones too. If you look at the technology side of things, what's in there? Materialize, and it's NVA. I know nothing about that company, but that looks kind of interesting. If you look at some of the commodity chemicals, you've got Trade GR Corp. I don't know that company at all, but anyways, you can see what my point is here. There's a lot of these that are going to be benefiting from copper. When you make a battery-powered car, you're using somewhere around 180 pounds of copper. Now, very interesting, I'm having some reno work done on my HVAC system, and they just put one of those instant hot water things in my house here. All the piping that was copper when the house was built 20 odd years ago, now replaced by virtually all plastics. So copper demand goes up in some places, down in others, very interesting. But I think as infrastructure gets built out, some of these base metals are looking very, very interesting here. Markets, okay, so last question here on the tactical growth and dividend fund. And so I want to take those because those are the funds I manage, and it's important that we answer those questions. Can I walk us through a market scenario where we see the BMO tactical growth and dividend get significantly more invested or a higher beta? And so the answer, Shell, is that yes. So volatility to the downside here with big infrastructure and spending coming should mean that with all the Fed support, markets go higher. Now, fundamentally, I don't like it. I'm not bullish, but I'm going to expose the portfolio to more beta and more growth because that is going to drive markets, and it's going to make markets even more inflated. So if we get into a scenario where the Democrats control all three parts of the White House and the Senate and the House, they're not likely going to raise taxes next year. They're going to spend a lot of money, and markets should respond favorably, but then they're going to raise taxes and capital gains, and then the markets could have a very bad few years. And in that scenario, we'd want to be hedged again. So lots of volatility coming. Folks, we are out of time tonight. Thank you so much for staying with us. Hopefully you learned stuff from our partners and in my chat tonight and through the Q&A. Thank you very much. Please go visit one of our partner websites if you're at all interested in some of our services. And please, please, please make a donation to one of the links that comes out in the email. Thank you very much. And I'll be glued to the TV at 9 o'clock for what's surely going to be an entertaining debate tonight between President Trump and Vice President Biden. Be well, everyone. Stay safe. Thank you.